Good afternoon, everyone. My name is Marissa, and I will be your administrator today. Welcome to the March 2023 First Friday webinar. Today's presentation is titled Signal versus Noise. Our prepared comments during this session will be recorded, as other families who are unable to attend have asked us for the recording. Please note we will not record your questions, as privacy is always a top priority for our firm. Our prepared remarks today will be between 15 and 20 minutes long, with some time left over to cover questions from the participants, along with our standard topics, which are what is the market missing and what is the fair value of the market based on the current assumptions.
Okay.
If you have already sent us your questions, we want to thank you because your questions help us understand what topics are truly important to each family we serve. If new questions arise from the content of today's presentation, please either send the question along by typing your question in the chat box at the bottom of your screen, or write it down and raise your hand at the end by clicking on the icon at the bottom of the screen. And we will do our best to come to you at the end of the prepared comments. One final note, please remember to mute your device's microphone and stay on mute, as background noise is audible and distracting. With that said, let me turn the presentation over to Stephen Abernathy, who will provide today's commentary.
So hi guys, hello everyone. Let me, as always, take just a moment to welcome everybody to March's First Friday discussion. And as always, we want to thank you for setting aside the time to discuss some interesting topics. I know it's Friday afternoon, but I hope you'll find these topics helpful when making decisions about your family's assets. That's always our goal. We want to make sure that everybody has the ability to aggregate the right information and to act intelligently. Today, we're going to discuss the wide chasm between the stock market and the economy, because that's where most of the questions have come this week, or most of the comments have come not only this week, but the last month. I do want to tell you, I don't recall a period in which there's been such a significant disconnect between what's really going on in the economy and what the stock market is doing. I literally am sort of scratching my head, but maybe we have some answers. So what I want to do is to discuss the reasons for the disconnect as best I can see it, and focus on the difference between what we label as signals, or what we define as signals, and what we define as noise. Said differently, what you really should be paying attention to and what you should be ignoring. And at the end of the discussion, we always have our favorite two questions, which are, which every self-respecting analyst or engineer answers. So first, let's describe the differences between signals and noises as Webster would have it. So a signal is just a gesture or an action which conveys information or instructions, something that conveys a notice or a warning. So that's sort of what we want to be paying attention to. And noise, obviously, is it's static. And it degrades the useful information embedded in a signal. And this is what I think a lot of people are making a mistake about. I have a comment here that I wanted to read to you, and it says that this topic is one of the important topics in life, because we all know the difference between signals and noise, yet many people just don't put it to use. So for the discussion today, signals are going to be useful information in our quest to control the risks and to make intelligent decisions, and noise is going to be the information that I believe you should avoid, because in my opinion, at best, it's nothing more than a distraction, and at worst, it really is misguided information and it can lead to very bad decision making. So how do you separate the two? And that truly is the $1,000,000 question. As I said earlier, every analyst and engineer knows the difference between facts and opinions both have their place in life. Yet, for today's discussion, we'll do our best to separate the two. So, signals. Um, Again, for our use today, they're going to be based on data that help predict the economy and the values of investable assets. And noise is singularly a narrative or an opinion. It may sound interesting at the time, yet it's largely no more than a story meant to entertain or just satisfy you. And last week, we identified three indicators which independently are almost infallible singularly. And in combination, they're as close to seeing the future as we can get. And these are what they are. And these leading indicators truly are signals. Everyone on this call needs to make sure that if you're going to be involved in allocating your assets, just check the box. So the first is the Federal Reserve. Sorry, excuse me, guys. So the first is the Federal Reserve, and I guess the easiest way to say this is if it's increasing the money supply, it's trying to increase economic activity, and the wind is generally at your back. Anything can happen, unforeseen events can take place, but in general, the Fed is being accommodative. And if the Federal Reserve is pulling money out of the economy, most people forget this, but they're purposefully trying to slow the economy, and the wind really is in your face. This indicator singularly stacks the odds for you or against you. Next, when short-term interest rates are higher than long-term interest rates, as we discussed last week, last month, it makes no sense. The Federal Reserve is sending you a message you shouldn't ignore. It's called the inverted yield curve, and it's, if it's in place long enough, so if short-term rates are higher than long-term rates long enough, it will suffocate our economy. It's almost often intelligent when the yield curve is indicated, please pay attention and reduce risk. The last is a very high probability signal. It's the index of leading economic indicators. And this list of 10 independent indicators is incredibly accurate. We'll go through each very quickly because we went through them last month, but we have some new people on the call today, and I want to make sure that they're at least getting one quick shot at what we're talking about. Here's the history since 1980s of interest rates coming down in blue and the stock market, which is in green, going up. The reason I have this slide here is twofold. Number one, to show you the relevance or the correlation between interest rates coming down being accommodated for the stock market and interest rates going up being non-accommodated for the stock market. As you can see, we're coming off about a 15-year sort of period of almost no interest rates. And it is going to be hurtful. This slide we discussed last week shows that since 1960, that's almost 60 years now, interest rates or the Fed has been accommodative. In 2022 was the first year in almost 60 years that the Fed has actually taken money out of the system, and it's continuing today. for sure. I guess the message I'm trying to say here is the Fed really is serious about slowing our economy. And um, and if money is going out of the system, the economy will slow. It can't self combust. Our second signal, which is the inverted yield curve, is is almost infallible singularly. This chart started back in the 60s, and the inverted yield curve has now been in place since mid 2022. When short-term rates are higher than long-term rates, as we said earlier, a recession follows over 90% of the time. The last of the signals is the index of leading economic indicators. While it sounds pretty much self-descriptive, it's been trending down for the last 12 months. This chart proves or shows the relevance, or I guess how would I say the potency of the LEI. When the LEI turns down, a recession usually follows. It's about 90% also, and it often acts with an 8 to 12 month lag. So as we all discussed last month, each signal indicator by itself is powerful. However, when all three are pointing in the same direction, it's just not an intelligent bet to bet against them. So, what's the noise telling us? Noise, as we said earlier, often consists of lagging indicators. And today, those indicators are sending us a mixed picture. So, inflation, as you know, is improving or is proving to be stickier than our government and the stock market thought. The reason is likely to be because our economy seems stronger than we thought, and it's probably because of the stimulus programs, which have led to a lot of things giving legs to this economy. Um, while this seems to be a good indicator, meaning inflation is robust and our economy is doing well, the stronger our economy, the more restrictive the U.S. Federal Reserve is going to have to be to tame the inflation. And the Fed will eventually push us into a recession. Employment, it's at a 50-year high, 50 years. And wages continue to grow at almost 5% per year. When wages are growing at 5% per year, it's almost impossible to get inflation under 2%. It just doesn't make any sense. So we think that's going to also lead the Fed into being much more restrictive. So the remaining three lagging indicators are recessions, which are by themselves or by definition, they're backward looking. You can only determine a recession is taking place once we have 2 quarters of negative GDP. The press is largely responsible for creating a narrative and is almost always wrong-footed. And the talking heads on television, I just want to take a moment and remind everyone that they're actors, not analysts. They're paid to make attention-getting statements and to keep you glued to the tube so they can sell commercials. So they have they have, I'm not saying they're malicious. I'm just saying that they have a goal, an incentive dictates behavior. They're going to try to sell commercials. So both the press and the talking heads, their track record is absolutely abysmal, and they are most often discussing what they think are predictive indicators with little predictive quality at all. So why is the market continuing up with clear and well-known data telling you that it should be down, and as I'll show you, by as much as 40 or 50%? The consumer really is strong. and it's still flush with cash. Our research tells us that sometime in the third or the fourth quarter, the consumer will be back to flush, will be back to even as they were before the pandemic struck. But we'll see. Stimulus programs today continue, whether it's the Semiconductor Act or this Inflation Reduction Act, which I really do have to scratch my head. I don't want to become political in any way, shape, or form, but it seems very curious that the administration is acting in direct, I don't know, in direct opposite direction with the Federal Reserve. I just don't really understand it. Employment is at a 50 or actually a 60-year high, and wages continue to increase at 5% a year. And that is by definition going to fuel inflation for much longer than the market is predicting. And they are predicting that by the end of the year, the Fed will have stopped increasing interest rates and will start decreasing interest rates. I find that a little hard to believe unless something really goes wrong. So, what's the market missing? It's the same thing that it was missing last month. This is the same chart I showed you last month, and I don't want you to get bored with it, but it hasn't been updated. And what it shows is that profit margins at the corporate level are deteriorating. They're deteriorating from a almost record high. However, it doesn't matter. Profit margins are going to come down when companies are forced to pay their employees and are probably overly employed or have more employees than they need, and they're increasing wages at 5% plus per year. Believe me when I tell you, at some point they won't be able to pass those margins along, and margins will continue to shrink. Typical gross margin is somewhere in the area of 7.5 or 8%. That's considered to be a great gross margin or an average gross margin. And what that means is earnings should be down by 25 or 30%. This is the estimate of earnings that you saw last month. It is largely unchanged. It's come down just a little bit. But as you can see, these predictions by Wall Street's, who's incented to talk the world up every month, these estimates, they're just going to be wrong. And in our best estimates, earnings will be down 10% this year, and they may be down 10 or 20% next year. The average over the course of the last 100 years, during a recession, earnings decreased by approximately 20%. If that happens, what you're going to find is that the marketplace won't be at 4,000 on the S&P 500. The fair value is much closer to 3,000. That's fair value. But I also want to tell you, and everyone on this phone has been around the marketplace well enough to know that when you come from an overvalued market and you move into a recessionary / depressionary scenario, the narrative changes. And it changes from, everyone needs to buy the dips and everybody's asking me what I should be buying. And the narrative really does change to, hey, what should I be selling? And get out at any cost. So that's where we are right now. Fair value for the S&P 500, if earnings decrease by about 10%, will be somewhere in the 3,000 level. And it wouldn't surprise me to see the S&P 500 somewhere in the 2,800 or 25 to 2,800, because it, as I said earlier, it largely overshoots. And again, I'm not trying to be a glass half empty person. I'm just trying to tell you the facts so that everybody has reasonable expectations. There is a little bit of a silver lining, as we all know. Once valuations come to that level, um, it becomes, there are some values to be had. Okay, it looks like I'm locked up here for some reason. Um, Two questions, or the major last question is, what happens if we're wrong? As you can see, the market now is 2 standard deviations above the norm. This chart is about a month old, and the most recent chart I saw, which I couldn't get access to yet, shows that we are about 98% overvalued currently today. The reason I put this up here is because the Q ratio is a measure of book value. So it's really a measure of replacement cost for the S&P 500, and it's it should be at about 0.67. As you can see, the geometric mean right here is around 0.7. It's a fair value for the world, no matter who you're talking to. And the point I put it up here is that if the wind is in your face and the market is overvalued, it probably makes sense not to push it, not to take on more risk. And Ed Easterling did some really, really good work, and he continues to do great work. He's a native of Oregon, and this chart right here shows that in green you'll see the annualized return over a 10-year period, and what that's biased against is the PE ratio, which is in orange. As you can see, the higher the PE ratio 10 years before today dictates the yields or the returns for the next 10 years. It's a complicated chart, but what you can take away from this is that 10-year yields are telling you that the forward-looking returns on the market are not going to be what you've used to, what historically you've received, about 10% with inflation and about 6.5% net of inflation. It's not going to happen. So in our opinion, a 5% treasury bill or a 4.5% treasury bill with no risk seems to be awfully interesting. And it gives you the ability to be liquid at any point. And at some point over the course of the next couple of years, where our best guess is sometime in the last portion of 2023 or during 2024, we're going to enter a recessionary period. Earnings are going to be reduced significantly, and values will start to materialize. Okay, let's leave this as it is and stop. I know that we've had a couple of questions, and we had two really good questions. One is from a gentleman who was not an engineer but acts like an engineer, and he asked me some of the best questions all the time. Uh, he asked a question about home prices and whether the fact that home prices are, or that interest rates are increasing at such a rate that will that cave in the home price sort of structure of our economy. And what I had a chance to get for him was in 2008, approximately 45% of all homes were financed with adjustable rate mortgages. During the last 10 years, as interest rates have plummeted, we are now at only 15% adjustable rate mortgages, meaning the 85% locked in a fixed rate at a longer term. So while there will be some people that will get in trouble and others who are overlevered will always be at higher risk or a higher probability of getting in trouble, it seems as if the housing market isn't going to be the cause of our distress. So thank you for that question. And he always asks me really great questions. The second question is from an engineer, and it's a classical engineer type question, which is what would have to happen for me to admit that I'm wrong and that the market is right, which is very possible. And I guess what I'd have to say is we would have to see earnings maintain their upward bias. Don't forget we're at 19 times earnings now. So and historically 15 times earnings is about right. So we would have to have earnings continue to increase at their current levels. We would have to tame our budget deficit. And we're going to have to get through our budget this year itself. I don't expect that's going to be a problem, but it may very well be. And this assumes also that all of our geopolitical problems or challenges will go away. That means that we prevail upon Ukraine to push for a solution with Russia, some sort of settlement. I wish they could come to some sort of a settlement. And at some point, I think cooler heads will prevail, and there is a solution there. I don't know what it is. And it also assumes that China and the United States start to cozy up a little bit, and that China doesn't make its classical move on Taiwan, obviously. So if all of those things start to happen, listen, I would be very happy to see the market continue to levitate and to be here. We as a family office, and most of the families are in very similar situations, are structured to be how would I say that, to seek dividend and interest income so that we can endure through anything and we don't have to look too much at the daily movements of the marketplace. Every person inside the family office or that we serve has told me in one way or another, I just don't want to have to go out and make it all again. So that's our directive, and that's how we're largely structured. With that said, Marissa, can I turn it over to you to see if there are any attendant questions? And please, if there's anything on your mind, let us know. And I wanted to give you one more thought here. Next month, we're going to try to have a moderator to make it a little bit more lively with a question and answer session. I'm largely going to be answering some questions, and the moderator is going to be aggregating questions and posing questions themselves. Marissa, any thoughts?
No, that's exciting for next month. No questions have been received from attendance today.
Okay. If anybody has attendant questions regarding anything that we've discussed in this call, please don't hesitate to reach out to me. I'm going to be around here for another hour or so. Otherwise, I'm wishing everybody all of the best, and onward and upward. Bye now.